Welcome back to China Gateway 360. If you're navigating China's business landscape, you know time is literally money. Right now, global markets are bracing for a massive cross-border investment announcement from Beijing, expected this July 1st. We're talking about the highly anticipated Hong Kong REIT Connect. So, today's explainer, it's all about sharp, data-driven, actionable intelligence. No fluff, just what this actually means for your global portfolios. Let's get right into it.
You know, there's kind of this golden rule for navigating the region. Beijing absolutely loves an anniversary. They've got this super consistent track record of using Hong Kong's July 1st handover anniversary to drop major financial opening measures. It's highly choreographed. Understanding this precedent is exactly why this date matters so much to institutional players. It's not just a rumor mill churning, it's a structural, bankable pattern.
Just look at the history. The pattern is totally undeniable. Back in 2017, boom, we got the Bond Connect. Fast forward to 2021, the Wealth Management Connect hits, and then literally just a year later, ETF inclusion. Every single one of these was a July 1st milestone that sparked massive cross-border capital flows. So anticipating a 2026 REIT Connect? That isn't wild speculation. It's a highly predictable trend built on years of systematic financial integration. Basically, Beijing has been sequencing its market openings, and real estate investment trusts are clearly up next.
But here's the bottom line, and it's a big one. Come July 1st, a $24.7 billion market suddenly cracks wide open. For foreign institutional investors who have historically been stuck behind strict onshore quotas, this is huge. It's a sudden, highly liquid channel straight into Chinese infrastructure.
Section 1. Sizing the REIT market, the RMB 180 billion opportunity.
To really wrap our heads around this REIT opportunity, we've got to look at the macro picture first. As of mid-2026, the total value of China's broader commercial and infrastructure real estate market, it sits at a staggering 1.2 trillion RMB. That's enough to make anyone's head spin. It's a massive total addressable market that really contextualizes the immense physical landscape we're dealing with here. But, you can't just go out and buy a piece of a trillion-dollar market directly. You need vehicles. You need public trusts.
And that brings us to the accessible slice of that giant pie, which is 180 billion RMB. As of June 2026, China's publicly offered REIT market has been on an absolute tear since its launch back in 2021. Today, we're looking at 62 infrastructure REITs trading on the Shanghai and Shenzhen exchanges, and together they have a market cap of around 180 billion RMB. This is the exact targeted pool of capital that becomes immediately and easily accessible to foreign investors the second this Connect program goes live.
Let's ground those huge valuations in some physical reality, though. What are we actually buying into? We're talking about the toll roads that power domestic e-commerce. We're talking industrial parks, critical warehousing and logistics hubs, rental housing, and clean energy grids. This is the literal physical backbone of China's domestic economy and supply chains. Historically, foreign capital has been pretty locked out of these specific sectors. By opening up these asset classes, the REIT Connect allows global investors to directly capture the yield from this foundational infrastructure for the very first time.
Moving on to Section 2, Cross-Border Mechanics, the Technical Architecture.
So how does it actually work? Well, Beijing is building a two-way street here, very likely mirroring the frameworks we already see in the stock and bond connects. On one side, you have northbound flows. This is foreign capital moving through Hong Kong brokers straight into mainland-listed REITs. But just as importantly, you've got southbound flows, allowing mainland Chinese investors to cross the border and scoop up Hong Kong-listed REITs. Both markets get this crucial new access, creating a super dynamic two-way liquidity channel. Now, underneath all those flows is the actual plumbing. The settlement gateways here will be the Central Money Markets Unit, or CMU, and the China Depository and Clearing, the CDC. Why on earth does this technical plumbing matter? Because it proves that while China is definitely opening the door, they are keeping a very firm grip on the doorknob. If you look at recent extraterritorial merger reviews by China's market regulator, SAMR, it's clear Beijing views capital market connectivity as a strictly controlled, highly sequenced process. They absolutely want foreign capital, for sure, but they want it flowing through a highly regulated, transparent clearing gateway that they can monitor perfectly.
Section 3. Valuation and Liquidity Impact, the Market Sentiment Boost.
We really need to talk about timing, because it is deeply strategic right now. Down 18%. That is the year-to-date performance of the Hang Seng Properties Index as of late June 2026. Ouch, right? Hong Kong's real estate sector is currently sitting in a multi-year valuation trough. The market is seriously struggling. So dropping a REIT Connect announcement right now, it acts like a strategic defibrillator. It injects desperately needed liquidity and a massive sentiment boost to both markets. That southbound mainland capital flowing into Hong Kong could be the exact spark needed to stabilize these distressed valuations.
To truly understand the potential upside here, we have to look at past precedent. For some context, the existing Stock Connect northbound channel handles over $300 billion in monthly turnover right now. Take a second to let that number sink in. $300 billion every single month. That is the massive, established scale these cross-border programs can achieve once they are fully up and running.
Which brings us to the real aha moment of this whole explainer. If the new REIT Connect captures just 10% of the Stock Connect scale, literally just 10%, that would inject $30 billion in incremental foreign capital right into China's infrastructure REIT market. To put that into perspective for you, that single influx of capital would more than double the current foreign ownership in China's infrastructure REITs overnight. The sudden shift in demand dynamics would be an absolute game changer.
Section 4. Investor Action Plan. Your next moves. Look, at China Gateway 360, we don't just throw data at you. We are entirely focused on actionable intelligence. So here is the rapid-fire tactical plan for your global C-suite. Step 1. Watch the July 1 scope closely. Are they kicking things off with industrial parks or toll roads? That's going to tell you exactly where Beijing wants capital the most right now. Step 2. Review your China real estate exposure against your existing QFII quotas. This new channel is heavily expected to offer lower minimum investment thresholds and way better settlement efficiency, meaning you might need to totally pivot your access strategy. And Step 3. Assess the Hong Kong valuation impacts. Southbound mainland flows could seriously compress cap rates on the Hong Kong side, fundamentally re-rating the current positions you might be holding.
I want to leave you all with this thought. If REIT Connect captures even a fraction of the historic volume we've seen with the Stock Connect, the capital influx is going to be immense. So the question every single institutional investor needs to be asking today is this. When this foreign flow fundamentally reshapes China's pricing dynamics for infrastructure, are you going to be positioned ahead of the curve, or are you just going to be left reacting to the headlines? The landscape shifts on July 1st. Plan accordingly. Thanks for joining us for this China Gateway 360 explainer. We'll see you next time.